Well, folks, it seems America's credit score just took a hit. Not the kind you get for missing a credit card payment, but something potentially far more significant. Moody's, the credit rating agency, has downgraded the U.S. credit rating. This isn't exactly a surprise party we were hoping for. It's more like that feeling when you check your bank balance after a weekend in Vegas. Now, I know what you're thinking. John, credit ratings, debt ceilings. This sounds about as exciting as watching paint dry, and you'd be right to some extent, but here's the thing. This dry, boring issue has the potential to impact all of us, from the price of gas to the interest rates on our mortgages. So, buckle up, America. We're about to dive into the wild world of sovereign debt, political gridlock, and the economic future of our nation. Don't worry, I'll try to make it as painless as possible, maybe with puppets. Let's start with the basics. Moody's is like the Simon Cowell of the financial world, except instead of judging aspiring singers, they judge the creditworthiness of entire countries. And their verdict on America? Not so harmonious. The reason? That old chestnut debt. The U.S. is currently sitting on a mountain of debt totaling $36 trillion. That's trillion with a T. To put that into perspective, if you stacked $1 bills that high, you could probably reach the moon and back twice, and still have enough left over for a decent sandwich. Moody's is worried that America's addiction to spending more than it earns is getting out of control. They're concerned that the government won't be able to keep up with its debt payments, which could have all sorts of nasty consequences for the economy. Think higher interest rates, a weaker dollar, and maybe even a full-blown financial crisis. Fun times. Adding fuel to the fire is a piece of legislation affectionately dubbed the Big Beautiful Bill. Now I know what you're thinking. John, that sounds like the name of a monster truck rally, not a bill in Congress. And you'd be right to be confused. The Big Beautiful Bill is a hodgepodge of tax cuts, spending increases, and safety net reductions. It's like someone threw a bunch of random economic policies into a blender and hit puree. The problem is this bill could add trillions more to the national debt, which has investors understandably nervous. Investors are like that friend who always lends you money, but then starts side-eyeing you when you order another round of drinks. They're worried that America is becoming a risky bet, and they might start demanding higher interest rates on loans to the U.S. government. That means less money for things like infrastructure, education, and healthcare, the important stuff. Section 4, Market Jitters and the Price of Uncertainty. So, what does all this mean for the average American? Well, in the short term, probably not a whole lot. The stock market might have a few wobbles and interest rates could creep up slightly. But the real impact of this downgrade will likely be felt over the long term. Think of it like this. Imagine you're buying a house. You go to the bank for a mortgage and they tell you your credit score is a little iffy. You'll still get the loan, but you'll have to pay a higher interest rate. Over the life of the loan, that could cost you tens of thousands of dollars. The same principle applies to countries. A lower credit rating means higher borrowing costs for the U.S. government, and those higher costs will eventually trickle down to us, the taxpayers, in the form of higher taxes, reduced government services, or both. Section 5, the long road ahead, a call for fiscal responsibility. So, what's the solution? Well, it's complicated. There's no magic wand we can wave to make $36 trillion in debt disappear overnight. But there are steps we can take to get our fiscal house in order. It starts with our elected officials in Washington, D.C. They need to get serious about responsible spending and find ways to reduce the deficit. That means making tough choices like cutting spending, raising revenue, or dare I say it, a little bit of both. But it's not just up to the politicians. We, the people, need to demand better from our leaders. We need to hold them accountable for their fiscal decisions and make it clear that we're not willing to pass this mountain of debt on to our children and grandchildren. So there you have it, folks. The U.S. credit downgrade is a wake-up call. It's a sign that we can't keep spending beyond our means forever. It's time to get serious about our fiscal future before it's too late. Now, if you'll excuse me, I'm going to go pay off my credit card bill. Before Moody's comes knocking on my door.